Last time we had talked in March, you were a little bit more cautious on M&A markets. Maybe it's time to put the pom-poms away. Since then, in the first quarter, it was a record first quarter. The M&A taps were wide open. So what gives? How did we end up having such a strong start to the year despite all of the headline risk?
Well, everyone counts the data a little bit differently. The way we look at it, sort of fundamental M&A, it's up maybe 5–10% off of a year ago. You get into all sorts of issues about whether or not do you count data center investment, what's the annualized run rate versus year on year. But the way we look at it, we think the market's up about 10%. And if you rewind the tape, that's where we had been at the end of last year, where we said there are long-term fundamental changes in the way in which the economy works. Companies, whether they're private asset managers or strategics, need to react. There's going to be a continued level of activity, but let's not forget 2025 was a pretty high bar. And off of those levels, trees don't grow to the sky, maybe up 10, up 15%. So in that sense, I think we're pretty much on track for what we thought. But when we met last time, I think since then, everything is higher. So earnings are higher, share prices are higher, energy prices are higher, inflation expectations are higher, interest rates are higher. But the one thing that isn't higher is conviction. And I think until there's greater conviction about the direction in terms of the resolution of these geopolitical risks and some of these debates about AI and not just winners, but also losers, until there is greater conviction, I don't think you see a step function change to higher levels. So we're at healthy levels. We're just not at accelerating levels.
What is the risk that the conviction is the other way, that it's a conviction that AI is disrupting too much, that energy prices are too high? Could that be the direction from here?
Well, at some point, you need the markets to reflect that consensus. And as I said last time, once you get to that new equilibrium, and that's the baseline, and that's the way in which people can get comfortable transacting off of that equilibrium share price, then I think you move higher. So it's going to be bumpy. And one of the things we've talked about is we live in an increasingly volatile world. The news flow goes from bad to good and back and forth, oftentimes, in a matter of moments. And until some of that volatility comes out of the system, it's hard to really see it. So there's no doubt that some of those shocks could lead us to a pause. But at the end of the day, all of these disruptive forces, changes in energy prices, access to supply, those are going to require companies to reimagine their supply chains, to change their investment focus. And that means you're either selling or you're buying or you're doing something. You're not standing still. Right. So it's all long-term good.
Even so, sponsored-backed deal-making hasn't come back in the same way. Private equity deals, they were still down quarter-over-quarter, year-over-year in the first quarter. What does it take to get them back?
Well, it's a complex problem because so much capital was deployed, and so much of it was deployed at the peak of the market in 2021 at record valuations, near zero interest rates. And since then, a lot of the evolution of those portfolio companies has not gone precisely according to plan. And I think for a lot of these alternative asset managers, you need to time the exit. One of the things that private equity is exquisite about is timing exits. And if it weren't for the need to return capital, they've taken the view that the right way to maximize value is to extend the runway and to play this out for a little bit longer. The challenge has been that while they're doing that, there's an imbalance between the capital that's been called and the capital that's been invested and returned, and that's what's causing a lot of pressure on these alts folks. But I don't see a fundamental change in the activity levels until there's a sense that these portfolio companies have gotten to their optimal harvesting period. And right now, having bought a lot of these assets in 2021, today is really not the optimal harvesting period.
I mean, you could make the argument that they just haven't marked their assets to reality and you might not get to that period.
Well, there's certainly that point of view. The reality is also that a lot of these assets are disproportionately invested in industries and companies that are vulnerable to AI disruption, as opposed to investing in opportunities that are capitalizing on AI disruption. So you have a little bit of the fact that too much money put in at the less than optimal time. The portfolio of assets was invested in situations that are not, with the benefit of hindsight, the best, but there still are opportunities to manage your way out of this. And I think that's where the LPs have given their capital and their decision-making to the GPs. And the decision, more often than not, has been, let's play this out a little bit longer.
I wonder how private credit fears come into this. I know in your latest earnings call you said we don't see systemic issues. We do think that this is undoubtedly slowing the pace and potentially cause a retreat in retail flows. How does that affect the overall ecosystem?
Look, I think, first and foremost, I think it's an issue for what's the pace of asset gathering. And so much has been made of accessing retail channels and finding more product that can go into retail channels. Private credit, when you talk about best of both worlds, having the ability to have attractive investment returns at the same time you can get liquidity back most of the time, I think that best of both worlds is the case 90% of the time. In an environment like this, best of both worlds becomes worst of both worlds, where you've promised liquidity and retail investors don't hear beyond that. It's liquidity subject to, they don't hear the subject to. And right now you've got a public relations challenge more than anything else. So my view is that retail clearly is going to stop fueling the growth in AUM for private credit. There's an increasing realization it's an institutional product, not a retail product. There will be nicks and bruises and losses along the way. Some of it's reserved for it, maybe not all of it. Underwriting standards are tightening up. There's more focus on comparing private credit versus the syndicated market, which is creating perhaps a better sense as to where and when are the right opportunities for private credit. All of that being the case, we don't see it as a systemic issue.
By the way, are you starting to see deals more increasingly being funded by broadly syndicated markets? Has there been a pullback in use of private credit?
There's certainly been a shift, and the balance is a little bit more towards syndicated. But we've always believed that issuers need to test both markets, and being able to consider the benefits and opportunities of the syndicated market versus the private credit market. That's more choice. That's more opportunity. And we're uniquely positioned to represent issuers and decide which way to access capital, whether it's in the private market or the syndicated market. But if you ask me what the trend has been over the last 6 months, it's moved the pendulum more towards the syndicated market.
I mean, whenever you have a credit cycle of sorts, and we can discuss whether or not we're going through that, but various issues in the market have brought forth more regulation, whether it be the SNL crisis, whether it be the GFC. Could that be the direction that we're headed at the moment, where there is more regulation around things like credit because of the fears over retail exposure?
There certainly is an increasing awareness that when you deal with retail investors, the level of protection needs to be amplified. Now, in an environment where regulation writ large is viewed as an impediment to growth, that sometimes loses out in that push-pull, less regulation, protecting retail investor. My sense is that that's really going to come to the fore if and only if there are real painful losses that retail investors experience, and then there'll be a review of regulation. But inevitably, I've been around so long, I know that the pendulum just moves from side to side. Right now, we're in a dereg mindset. But at some point, if there's real harm to retail, that's when you get the political machinery focusing and protecting the individual.
I mean, is it fair to say that this industry just made a mistake in marketing these things as semi-liquid?
I don't know if it was a mistake. It's just that there are the words, and the words as articulated were precisely what the private credit was. But that's not the way they were heard. So to me, it's simply a marketing challenge in an environment that resulted from an unanticipated change in values and desires for liquidity from retail. And I suspect that the lesson will be that retail is a wonderful channel, but you really need to treat it with kid gloves when you try and tap that market, because at the end of the day, it's a different level of sophistication. They're very vocal, and you need to make sure that at all times you're thinking not just one step ahead, but sort of what if. And we're in one of those situations where some of those what what ifs are causing some real uncomfortable situations.
Okay, so a lot of this did start just in software exposure, and it feels like the risks around software, while not the best understood because we don't know where the world is going, they certainly have gotten attention. Are there any outstanding risks that you think overall this market is ignoring rather?
I'm amazed at how often we look at what the conventional forecast is, what the consensus is, without looking at the tail risks. My own view is we're living in a world where every day there's an interconnected domino somewhere that's falling, that's creating an unanticipated outcome. Most of the time it's in an outcome set that can be easily managed. But the more complex the world becomes and the more shocks to the system, whether they're geopolitical, technological, political, the more that happens, the more the risk of a tail result. And I just have a general sense that while I fundamentally agree with the consensus call or the expected view of where the economy is going, the tail risks of severe outcomes continue to rise, and the market, in my opinion, isn't really pricing that tail risk. And if you end up in one of those tail results, then you're in a whole different place.
By the way, how do you, as a business leader, of manager of many people at PJT Partners, think about that, specifically the tail risk of AI and how fast it's growing and how disruptive it could be for your business itself? How do you prepare for those types of tail risks?
It's a real challenge because the first impulse is to do something and to move with great speed and great rapidity because the world is changing and you need to be on top of it. At the same time, early on in the evolution of this industry and this magical transformation, the risk is that you end up making decisions early on that very quickly prove to be the wrong decision. So it's how do you change the culture and change the mindset before you change the technology? And what we're spending a lot of time on is trying to get our senior partners to be the power users, to learn to really use this technology. We'll figure out ultimately what are the data sources, who's going to be the provider of our engines, what's going to be the fully built out backbone, what are all of the cybersecurity protections. All of that comes, but you have to start culturally that this technology is your friend and it's not a threat, because if you just run from it, then you never evolve the organization. So it's a real challenge as a manager.
Just on that note, when you saw the Mythos news, did you pick up the phone, call Anthropic, and say, hey, can we get our hands on this thing?
Well, I certainly thought that. I didn't think they were going to return my phone call, so I didn't make the phone call in that regard. But I certainly said I wouldn't mind having this
that
as
seems
well.
like a big threat, though. That kind of technology in the wrong hands?
There's all sorts of unanticipated outcomes from all of this, and the pace of technological evolution is morphing into a revolution, and the question is, can government and regulation and policy keep up? And that's what makes it super challenging. That's at the macro level. At the micro level, as a business manager, you're trying to make sure that you don't make decisions early on just because you want to be, doing something. You want to be on the forefront and then find out that you have the white elephant.
Right.
So you've got to build this not just for the next 10 weeks. You've got to build this for the next 10 years. You've got to build the mindset first, and that's where we're spending time on. And that's why, last point, Dani, we don't spend a lot of time talking about what this is going to do to headcount. What we want to do is we want to become more productive. We want to do more with what we have. We don't want to do the same with less.
Okay, just I want to end on a lighter note because this does feel like existential kind of thing. You've been asked to run the NBA expansion process.
Yes.
How's that going?
Well, it's a tremendous honor to work with the NBA. I had the opportunity to work with David Stern when he was the commissioner to set the expansion values back in the early 90s in Vancouver and Toronto. And the NBA has always been such a forward-thinking league that back in the early 90s, they were the first league to say, let's just not pick a number from the air. Let's actually do some financial analysis. Let's look at the long-term implications. And they brought a level of sophistication and acumen that really has set the standard. So it's a great privilege. It's a lot of fun, and we're hoping to be the partner of the NBA through this process and for years to come.
Do you think the buyers will look quite different for Las Vegas and Seattle now that we have the existence of private equity interested in this industry?
I think the NBA has so many tailwinds. It's such a global sport. If you look at what the NBA is doing in terms of tapping into that in Europe, where their media rights deal is, how immune what they do is from all of these AI threats that we're talking about. You know, the worst thing that will happen from a sports perspective is there'll be more leisure time and more appetite for the league. So whether it's Las Vegas, Seattle, or other quality markets, I think there's real long-term demand for this product.
So you have no names of buyers for us.